I have always been a very big fan of high income ETFs, especially during periods of heightened volatility, like we're seeing right now, because these types of ETFs can offer investors fantastic risk management and hedging potential thanks to their consistent income generation. That steady cash flow can help cushion downside volatility and give investors the flexibility to dollar cost average into quality stocks or ETFs that may go on sale. And the best part is that many of these ETFs distribute dividends on a monthly basis, and in some cases even on a weekly basis, which can be a game changer in building consistent cash flow in turbulent markets. Shifting gears, I came across a very interesting article that broke down 5 major investments that Warren Buffett made through Berkshire Hathaway with a portion of his massive $300 billion cash pile. And what really caught my attention is that all 5 companies were international stocks, mostly Japanese. But why? You see, it is extremely important to understand why international exposure matters, especially in a volatile market like the one we're in today. And I'll explain why in just a second. But my question is, what are the best ETFs for everyday investors to capitalize on global opportunities? How can someone gain exposure to global companies and help hedge their portfolios while also generating strong and reliable returns? But there's a twist. For me, high income is a key factor. So now the question is, what are the best ETFs that combine global diversification with powerful dividend income while still offering the potential for exceptional performance in today's market? In my opinion, if you can pair these two together, it is not just a defensive play, it is a complete investment strategy. The high dividends can boost overall returns, especially if international markets are suddenly moving more slowly. And in the long run, that combination can be a real game changer. So to begin, similar to dividend ETFs like SCHD or DGRO, international ETFs tend to experience less volatility. But US ETFs are still tied directly to the health of the US economy, interest rate policies, and the domestic political climate. And those are some of the biggest reasons many investors look to diversify globally. International markets operate under different economic conditions, and that creates opportunity. On top of that, many international companies generate revenue in their local currencies, which could appreciate in value against the US dollar if we see more rate cuts moving forward, and that is very important. Another key point is that international ETFs tend to be more heavily weighted in sectors like energy, industrials, financials, and infrastructure, areas that naturally carry less volatility and offer more stability compared to the US, which is heavily concentrated in large cap tech. So is there an international ETF that uses a high income strategy, something that both income focused and growth oriented investors can use to diversify risk while still aiming for returns in line with the S&P 500? Well, yes, there is. And that brings me to IDVO, which is the Amplify CWP International Enhanced Dividend Income ETF. Now, the name might sound familiar, and for good reason. It's part of the same ETF family as DIVO, which is another Amplify fund that I have consistently ranked as one of my top high-income ETFs on the market. In fact, about a year ago, I reviewed IDVO in detail and even built out a model ETF portfolio that included exposure to it. I'll be revisiting that portfolio and breaking it down in an upcoming video. But the reason I originally highlighted IDVO is very simple. It stood out by combining international diversification with a covered call strategy. And so far, it's delivering strong historical performance while maintaining that income advantage. And right now, the ETF is on fire. Now, aside from ETFs, when it comes to portfolio construction, I like to complement my allocations with individual stocks as well. One of my favorite tools for this is ProPix AI. This feature builds model portfolios based on different strategies, and it is designed to outperform benchmarks. And there are many powerful portfolio options you can choose from, such as tech titans, Warren Buffett's top 15, healthcare heroes, small cap sprinters, or the S&P 500 value portfolio. Every portfolio includes a detailed breakdown of each stock's financial health, earnings, cash flow, valuation, and even timestamps of when the position was opened or closed. I'm very excited to share that Investing.com has officially launched their Black Friday early bird sale, where you can get up to 55% off their plans. And if you use my link, you will get an additional 15% off on top of that, which means you can get up to 70% off. InvestingPro gives you access to a massive database of global stocks and ETFs, which is backed by deep financial data, research tools, portfolio analytics, and both technical and fundamental insights. You'll also find portfolios from top fund managers like Ray Dalio and Warren Buffett, which you can analyze or even replicate directly inside the platform. As always, past performance is not indicative of future results, and this is not financial advice. I am simply sharing one of the tools I personally use to enhance my own research. Another one of my favorite features is Warren AI, which is like their version of ChatGPT, but with access to a real financial database. So when you ask it a question, the response isn't just surface level, it is backed by actual data and analytics from their system. There's a lot to explore inside the platform, and if you'd like to check it out, you can use my link or code Victoria Media to get an additional 15% off, for a total savings of up to 70% off. Since inception, IDVO has returned 84%, which is actually superior to the S&P 500. And that alone is insane to me, especially considering the fact that it is a covered call ETF that doesn't have exposure to the same big tech stocks that were the primary drivers of the S&P 500 for the last 2 years. And year to date, the fund has crushed the S&P 500. The fund has a dividend yield of around 6%, which is very high. Over the past couple of months, this ETF has been gaining a lot of momentum. One of the key indicators I like to use to measure that is the growth in assets under management. Percentage growth of assets over time is where the real insights start to appear. It gives you a clearer picture of which ETFs are gaining traction and building trust with investors. This ETF was established in September of 2022, so it is still relatively new, but it does have a decent track record for investors to analyze. Now, the fund has around $500 million in assets under management. Over the past few months, the ETF has been gaining a lot of momentum. And currently, the fund has a dividend yield of around 6%, which is quite a bit higher than its US-based cousin DIVO, which has a dividend yield of around 5%. Now, the yield of this fund is made up of two components: the qualified dividends from the underlying assets that it holds, and the income generated from its covered call strategy. This is very similar to DIVO and even JEPI. But I also think there's a specific tax advantage here, especially for international investors, but I will dive deeper into this in another video. Now, as mentioned, despite the unbelievable AI momentum in 2023 and 2024, which drove majority of the returns of the S&P 500, to have a fund that is primarily focused in international stocks with a very diverse allocation, this performance is phenomenal. These are also superior returns to prominent high-income ETFs like JEPI and SPYI. Now, when you compare the charts of IDVO with the S&P 500, you can see that at times where the S&P 500 is seeing significant upward momentum, IDVO either follows or tends to lag. So clearly there's a strong momentum heading towards international investments, and IDVO is able to capitalize on that while providing a 6% yield, giving it the ability to outperform in a downtrend, but also provide superior returns in a sideways trend. Now, when you look at the fund's holding breakdown, you see that the fund has around 100 different stocks, and there are some very prominent names in its holdings, like TSMC, which is the world's largest semiconductor manufacturer, or Tencent, which is one of China's biggest companies. It's like combining Meta, Microsoft, PayPal, Netflix, and Amazon into one giant company. But there are also companies like Enbridge, Siemens, or Mitsubishi, which is one of those stocks that Warren Buffett's invested in. So there's clearly an emphasis on high-quality, reputable, and powerful companies. As you can see right here, the fund has a very even spread in international markets. Now, looking deeper into the fund's characteristics, the way the fund chooses the stocks in its holdings is based on a variety of factors. But the number one thing it prioritizes is dividend growers. So the fund searches for high-quality, large-cap companies that they believe over time will sustain their earnings and cash flow growth and increase their dividends consistently. And then they narrow down the portfolio to around 50 stocks. And then after that, they use a tactical call writing strategy, which I'll explain in just a second. But the one thing that really stood out to me was the fund's dividend growth rate. You see, covered call ETFs don't typically have a strong dividend growth rate because, like I said, their dividend yield is generated from two different sources. And it's really difficult to dictate the growth rate of a fund's dividends if option income fluctuates. But IDVO has managed to provide 2 years of consistent dividend growth and has a dividend growth rate of almost 12% over the last 12 months, which is higher than all of the ETFs in its category and extremely impressive. Now, one thing to note is that this fund's covered call strategy is extremely unique. Unlike most high-income ETFs that are based in US markets that sell calls on broad indexes like the S&P 500 or the Nasdaq 100, this fund's managers are strategically selling calls on each individual stock within the fund's holdings. So they are analyzing the price performance of each of these stocks, and the fund managers are deciding which ones are best suited to sell call options on. For example, if a fund is exhibiting more of a sideways trend or even a slight downward trend, then selling call options on that stock is ideal as you can generate extra returns to cushion the downside. But if a stock is showcasing strong upward momentum, like TSMC for example, then selling call options and limiting its upside growth is not ideal. That is why I really like the covered call strategy of Amplify ETFs overall. Now, I will be making another video going over a possible ETF portfolio that incorporates international ETFs, but of course with a focus on maximizing income generation. So definitely stay tuned for that. Now, there are some downsides to IDVO. For one, it's expensive. With an expense ratio of 0.66%, it is on the higher end, though it is also similar to other covered call ETFs. Secondly, it is pretty concentrated, so the price volatility of the fund will be more than an ETF that holds 200 or 300 stocks. Other than that, I can't think of any other major downsides. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. So overall, IDVO is an ETF that can not only provide hedging capabilities to diversify risk into international markets, but at the same time, the fund is using a high income covered call strategy that generates an exceptionally high dividend yield of 6%, which further helps cushion price volatility. And the fund's dividends are distributed on a monthly basis, which is very favorable. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.